Did you know that some NFTs could hit you with a 28% capital gains tax rate? That's right, a much higher rate than your usual crypto investments. The I.R.S. isn't messing around when it comes to digital assets, and NFTs are no exception. Every single thing you do with an NFT, buying it, selling it, even just minting it, can create a taxable event. In this video, we are going to dive deep into NFT taxes for 2026. You'll learn exactly how the I.R.S. classifies these unique digital assets, what makes an NFT a collectible in their eyes, and why that matters for your tax bill. We'll break down the tax implications for every type of NFT transaction, from minting to trading, and even cover what it means if you're an NFT creator. Stay tuned because understanding these rules is crucial to avoid penalties and keep more of your hard-earned crypto. So, first things first, the I.R.S. treats NFTs just like any other property. Think of it like owning a piece of land or a share of stock. This isn't new, it's been the case for all cryptocurrency and digital assets since I.R.S. Notice 2014-21. What this means for you is that anytime you dispose of an NFT, whether you sell it, trade it, gift it, or even exchange it for another NFT, you're triggering a taxable event. You have to calculate your gain or loss on that transaction, the I.R.S. even confirmed this specifically for NFTs in Notice 2023-27, giving us interim guidance on how they are looking at these unique assets. It's not just a digital receipt, it's a piece of property in the eyes of the taxman. Now, here's where it gets really interesting and potentially expensive. Under Notice 2023-27, the I.R.S. introduced a look-through analysis for NFTs. This means they'll examine what the NFT actually represents. If your NFT gives you a right to or ownership of an underlying asset that would normally be considered a collectible under IRC, Section 408 M2, like a piece of art, a gem, a stamp, or an antique, then your NFT is also treated as a collectible. Why does this matter? Because long-term capital gains on collectibles are taxed at a maximum rate of 28%. That's a significant jump from the standard 0, 15, or 20% maximum rates for other long-term capital assets. Short-term gains, however, are still taxed at your ordinary income rate, regardless of whether it's a collectible or not. So, that rare digital PFP could have a much higher tax bill than you expected.
Let's talk about buying an NFT, especially if you're using crypto. This is often a two-part taxable event, and it's where many people get confused. First, when you use Ether or any other cryptocurrency to buy an NFT, you're actually disposing of that crypto. So you need to calculate your gain or loss on the Ether you used. That's the fair market value of the NFT you bought, minus your cost basis in the Ether. Second, you're acquiring the NFT itself. Your cost basis for that NFT will be the fair market value of the crypto you use, plus any gas fees you paid for the transaction. Remember, according to I.R.S. Publication 551, your cost basis includes all costs of acquiring an asset. If you're lucky enough to buy an NFT directly with fiat currency, it's simpler. Only the acquisition happens, no crypto disposition to worry about.
What about minting an NFT? For buyers who mint an NFT from a smart contract, your cost basis is pretty straightforward. It's the mint price you paid, whether that was in crypto or fiat, plus all those pesky gas fees. And yes, if you paid the mint price in something like Ether, that Ether disposal is a separate taxable event. Just like when you buy an NFT, the gas fees you pay to execute that minting transaction, they're added directly to your cost basis in the newly minted NFT. Now, if you're an NFT creator and you're minting your own NFTs to sell, the act of minting itself usually isn't a taxable event for you. The tax event happens when you actually sell that minted NFT. Your cost basis as a creator would include the gas fees you paid to mint it, along with any other creation costs you incurred. When you finally sell an NFT, you'll need to calculate your capital gain or loss. This is pretty standard for property. The formula is your sale proceeds minus your cost basis minus any selling fees. So if you sold an NFT for, let's say, 10 Ether, and your cost basis was 3 Ether and you paid 0.2 Ether in marketplace fees, your net gain would be 6.8 Ether. Your sale proceeds include the amount you received after any marketplace fees like OpenSea's 2.5% service fee, the I.R.S., then looks at your holding period. If you held the NFT for 1 year or less, it's a short-term gain or loss taxed at your ordinary income rates. If you held it for more than 1 year, it's a long-term gain or loss, which could be subject to those lower capital gains rates or the higher 28% collectible rate if it qualifies. Exchanging one NFT for another NFT is also a taxable event. It's treated much like a crypto-to-crypto trade. Let's say you trade your Bored Ape for a CryptoPunk. You're disposing of your Bored Ape for the fair market value of the CryptoPunk you're receiving. You have to calculate the gain or loss on that Bored Ape at the time of the trade. The fair market value of the CryptoPunk you receive then becomes your new cost basis for that NFT. Here's where most people get it wrong. They think a trade isn't a sale, but the I.R.S. sees it that way. You can't just swap NFTs without consequences. This is also why keeping meticulous records of fair market values at the time of trade is so important. It's a lot to track manually, especially if you're an active trader. If you're an NFT creator, your tax situation depends on whether the I.R.S. considers you a hobbyist or a business. If you regularly create and sell NFTs with a clear intent to profit, the I.R.S. will likely classify your activity as a trade or business under IRC Section 162. This means revenue from your NFT sales and any royalties you earn would be reported as self-employment income on Schedule C. This income isn't just subject to regular income tax rates, which can be anywhere from 10 to 37%. It's also hit with self-employment tax. That's an additional 15.3%. 12.4% for Social Security, and 2.9% for Medicare on your net earnings. So, if you're serious about creating NFTs, you need to understand these business implications. Managing all these NFT transactions and their tax implications can feel overwhelming, especially with the collectible twist. This is where a tool like dTax becomes invaluable. dTax helps you track your cost basis, calculate gains and losses for every NFT transaction, and even identify potential collectible NFTs. It supports 22 blockchains, including 16 EVM chains like Ethereum and Polygon, plus Bitcoin and Solana, so it can handle your diverse NFT portfolio with 12 different cost basis methods. dTax can help you optimize your tax outcome. Plus, its AI tax assistant can answer your specific NFT tax questions. Check out getdtax.com. It's open source and free to start with unlimited imports and 5 AI chat questions per day to help you get a handle on your NFT tax. Let's tackle a couple of common NFT tax questions. First, are NFT royalties taxed? Absolutely. If you're an NFT creator receiving royalties, that's generally considered ordinary income, and it's subject to self-employment tax if your activity is classified as a business. Second, what about NFTs received as gifts? If you receive an NFT as a gift, you don't pay tax on the receipt itself. However, your cost basis for that NFT will be the donor's original cost basis. When you eventually sell it, you'll calculate your gain or loss based on that original basis. And finally, can I use NFT losses to offset gains? Yes. Just like with other capital assets, NFT losses can offset NFT gains, even up to $3,000 of ordinary income per year. It's a crucial part of tax loss harvesting strategy.
So there you have it. NFTs are property and the I.R.S. is watching. Don't let those potential 28% collectible tax rates catch you off guard. Understanding how minting, buying, selling, and trading NFTs impacts your tax liability is absolutely essential. Make sure you're keeping good records and reporting all your transactions accurately. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more crypto tax insights, and hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.